navigate these choppy markets essentially. So I'll just start with the equity market view here, as a starting point. What we have said is that, for an investor, what is very important, that this is very akin to, our model, is that, first of all, what I've said is that, return on capital and return of capital, both things are very, very important. And when an investor thinks about equity as an asset class, what should be your expectation? Like any other asset class, there are times to be underweight and overweight on equities. Equity is not a perpetual asset class until and unless you have got a stomach to look at, a 30, 40, 50% drawdown, which a lot of seasoned investors have experienced over multiple cycles. What I have experienced as a fund manager is that, that a lot of clients tell us that possibly, we are in equities for the long term. And this is especially true of impatient capital, which invests into equity for the first cycle. Possibly, you end up having a very, very bitter experience for two reasons. One is that, typically investors join late to the party. And people, for example, a classical example of this phenomena is the SIP book, wherein we saw a lot of inflows in SIP. And today we are at a juncture wherein investors after 3 or 5 years potentially are getting very, very edgy in terms of, not making possibly returns after 3 to 5 years. So it helps to be, underweight and overweight on equity as an asset class. Now it depends, what band of allocation do you have. From an investing perspective, obviously every investment book talks about, investing is all about buying fear and selling greed. But in practice, actually, we know that, it is very, very difficult to practice, in terms of, putting money to work when there is possibly, blood on the street or there is fear. What we have said is that, essentially we want to be more aligned to clients and goal setting is important. So I'll just leave to that and quickly move to the equity market view. The first thing that I would like to point out as a part of the equity thesis is that the last decade belonged to essentially developed markets. Within developed markets, it belonged to specifically US in terms of performance. I would just like to point out that, every decade typically starts with a new theme in the market. So essentially, if you look at, 1990s, it was essentially, it belonged to developed markets from 1990 to 2000. 2000 to 2010, it belonged to emerging markets, wherein, obviously India did, reasonably well in that decade. So did the rest of the emerging markets. And ever since 2010 to 20, it belonged to US. So what has happened in the US is that we all know that, US markets are trending and they are in a 14th year of this bull run, essentially. And that is how, earnings have trended there. It is very, very useful to remember what is happening to the dollar Nifty. So this is Nifty in dollar terms. What you see here is that, Nifty in dollar terms has not generated too much return, because essentially what has happened is that, rupee has moved from 40 to 75 odd level at this particular point in time. So this entire gain in this period of Nifty is lost for a foreign investor. The same is true of Brazil and Russia. The only difference being that, Brazil and Russian returns in dollar terms are much worse than Indian returns. The second thing that I would point out here is that, when do markets peak? In our view, markets peak when you have got peak earnings and peak multiples. At this particular point in time, all of us are aware that the multiple 1 year forward multiple and markets are clearly not cheap. And that is why people are becoming a little bit jittery at this particular point in time. So the Nifty forward P is close to 28, which is clearly not cheap, going by the historical context. And now theories have started to emerge globally. As recent as 2 weeks back, Robert Shiller said that, essentially I have to tweak the CAPE ratio, for which he won the Nobel Prize, essentially in terms of, looking at valuation from a lens of how do you look at valuation in a low interest rate environment. So what you see here is that, obviously multiples are elevated, but one thing which is worth highlighting is that since 2012 till now, what we have seen in the last 8 years, Nifty earnings growth has been 2%. So it is a number which is not even matching the nominal GDP growth. The key for markets to sustain going forward is going to be earnings growth. And at this particular point in time, the consensus is forecasting close to 25% earnings growth. Our belief is that, if you have mean reversion in earnings, and if earnings are in that trajectory of 10 to 15 years for next 3 4 years, possibly, this is going to be a buy on dip market. Another thing which is worth highlighting is that, what is happening to the construct of the market. So we have rebased, what happened in January 2018, wherein, I took a call to return capital to clients. What happened ever since then is that, Nifty is making a higher high. So what you see possibly is that, this 100 rupees in Nifty in January 2018 possibly has become, something closer to 130. What we also see here is that, small and mid caps saw a very, very sharp correction, but now they have started to recover. So essentially, they are trending up well. The rally is getting, broad based. And there are certain reasons, why this rally is becoming broad based, because the earnings growth is becoming broad based. But it is useful to know and understand this now, that Nifty is a function of 50% of Nifty is a function of only five stocks today. The level of concentration that we see in the market in terms of, these five stocks, which is a combination of Reliance, HDFC Bank, HDFC Limited, Infosys, and TCS. What we find is that, the Nifty is a very, very polarized index, because it is a free float index. So this is what I wanted to point out. A lot of stocks, roughly one third of small and mid caps are trading at more than 50% discount to what they were trading in 2018. And that is, obviously, it was a very, very overheated market. Now let us, try and understand why foreign inflow, why we have an influx of foreign inflow. In our view, there is a very important thing which has happened on the current account side. After 16 years, possibly at 45 to $50 crude, India is going to be marginally current account positive. So it is useful to remember that in a low interest rate environment globally, and if you are allocating capital, being an emerging market fund manager, the last thing that you want in a low interest rate and a low return environment is to lose money on the currency. And this is what has happened precisely. If you look at the currency, how it is trending, India, along with China, has been one of the best performing emerging market currencies in this period of turmoil. And what has happened is that, the South African rand took a beating, but it has rebounded very, very sharply in last 2 to 3 months. But what you clearly see here is that, Brazil and Russia took a very, very large knock. And that is one of the key reasons why foreign inflows have been, disproportionate in a market like India. Obviously, from an economy standpoint, where we stand today, uh, most of the indicators have normalized, which includes electricity consumption, movement of uh, passengers, railway freight, essentially GST collections are trending well, e-way bill movement, it is making a higher high. Property sales is a very, very interesting one. Our core belief is that, if economy has to do well, property and real estate as well as auto have to do well. And obviously, new job postings has started to, rebound. Now, our key thesis of, going forward is predicated on the belief, and let me step back here and, just let me point out that what was the problem in the economy. Essentially, in our view, the problem in the economy pre-pandemic was that, essentially, RBI was cutting rates in terms of, very, very uh, accommodative stance in terms of monetary policy, but the rate transmission was not happening in the economy. Now, what we have seen is that, because of COVID, essentially across auto or real estate, we saw rate transmission started to happen. And now what we see is that, a 6.5%, 7.5% home loan rate is, not many people would have imagined that mortgage rates could be so low in an economy like India. But today, the fact is that, obviously we are in a very, very low interest rate environment. And what we see is the repo rate or the GSEC rate continue to trend downwards. What is worth highlighting is that, the repo rate and the GSEC rate is lower than what it used to be in global financial crisis. So this is 2008, and we are trending downward. Another thing which is worth highlighting is that along with mortgage rates, what has also happened is that the vehicle loan rates have declined very, very sharply. So broadly we have seen a 1.5 to 2% decline in both these segments, and this is a big propeller for the economy, because auto is a very, very important part of industrial production. And on the housing side, obviously it is the second largest employer after essentially agriculture. What we are also witnessing is a very, very interesting phenomena at this particular point in time, is that what is happening in the commercial paper market. So what we are finding is that on the short tenure side, HDFC or Limited or a Reliance, Power Finance Corporation, or somebody like NTPC, which is essentially quasi sovereign, are borrowing at 3.5%, and this has started to now spill over to slightly longer tenure in terms of commercial paper market funding. What we have seen recently is that companies like Chola or Bajaj are borrowing at 4.5 to 5.5% for a 3-year paper. What it also leads us to believe is that these if these rates continue to stay here for longer, it is going to be start of the cycle essentially. And you just have to think about the US corporates here. What US corporates have essentially done is that in a low interest rate environment, corporates borrowed a lot of money and bought back the stock. India could possibly go through a similar sort of a phase. And what we believe is that that at this juncture there are a lot of interesting things which are happening. Now what you see here is a context of how capital adequacy of leading banks has behaved over the years. So what you see here is essentially a Kotak or a Axis. The first reaction function of a bank in COVID was to essentially go and raise capital, because everybody thought that there is going to be a wall of NPAs which is going to hit the banking system. Now essentially 9 months down the line, what we are experiencing is that the economy has started to improve, and obviously NPAs have not been to the extent as it was earlier anticipated. What essentially the banks have done is that you have created a COVID provisioning buffer to the tune of anywhere to the tune of 5 to 6%. What this has led to at this particular point in time is that this buffer in a negative carry scenario, and this is very, very important to understand. If you park your money with RBI today in terms of being a bank at the reverse repo rate, which is more like 3.3%, your cost of funding is sub 5%, but you still end up losing some 1.5% by parking money with the Reserve Bank of India. So initially what it led to was that obviously banks had buffer, but they are not going to go and start lending. What we expect going forward is that because the liquidity, as you see here in the system, is at an all-time high. So this is a combination of the LAF, MSF, LTRO, and various tools that RBI has used. What we see here is that this is a 10-year, this is possibly a 13-year chart that you see on the screen. India has never seen so much of liquidity in the system. So what it is leading to is that obviously at some point in time, RBI can cap the liquidity that you can park as a bank to RBI. And what we believe is that that is going to start the credit growth in this country. And at this particular point in time, what you see is that incidentally credit growth is also at an all-time low. Now, in terms of asset class performance, what we have seen is that gold has been a very, very respectable asset class to allocate capital to, especially if you have been if you have been in India, because as an Indian investor, you have roughly made 4% by investing into gold, because gold is a dollar asset, and that is precisely the sort of devaluation that the rupee has seen versus the US dollar. But what we have seen here is that gold has rallied very, very sharply. So within a year's time, possibly we have seen a very, very large up move in gold. Now, historically, if you look at and if you analyze what gold has got a high correlation to in terms of asset class performance, is with M2 growth globally, which is the money supply growth globally. What we have seen today is that possibly there was a phase wherein there was a lot of printing which was happening, and that led to the debasement of the dollar. Obviously, all of us are aware that the dollar index has been in a very benign sort of a environment, in the sense that the dollar has depreciated versus most of the developed market currencies, and that is attracting, or that is leading to a lot of inflow in the emerging markets at this particular point in time. But what you see here is that after the money printing or money supply growth, as soon as the money supply growth starts to taper off, gold has started to taper off. So this is something that I would like to point. Possibly gold is a good hedge in the portfolio, but the fact is that there are prolonged periods wherein gold doesn't do anything as an asset class. So it could be possibly you can allocate to gold, but you cannot size it. It cannot be possibly more than be like 5 to 10% of your portfolio. Another thing which is worth highlighting here is the how are the property prices behaving. And I think so what has changed very constructively for the real estate market in this country is that the first thing is that there is a change in attitude of government in terms of lowering the stamp duty collection. So it was earlier to states like Karnataka, but rarely you will see governments succumbing to pressure or government taking a step in terms of that I would axe my own revenue. And if you walk into a registration office, what you will find today is that it is buzzing, especially in Bombay. So what we find here is that there has been a prolonged period of sideways movement in terms of prices on the real estate side. Our belief is that property prices might not go up, but the flow of property will start to happen, simply because change in attitude of government, change in attitude of builders, in the sense that builder is willing to sell stock at a discount. The third very important thing which has happened, which is a massive stimulus to Indian middle class, is 6.75% home loan rate. Now, what it essentially means is that, earlier you used to have a 10-11% home loan rate in this country, and you had a 2.5-2% residential yield. Now, what has happened is that, obviously the residential yield is still at 2.5, but the rate of borrowing or of the mortgage has come down. So the spread has come down. As a result, what has happened is that the affordability factor has gone up. So what it means is that, more people would be willing to buy a property. And one of the trends, and we are very early to spot this trend globally, post the pandemic, millennials have started to prefer to buy a house versus renting a house. This is a very counterintuitive statement that I am making, but possibly COVID is going to have a very long lasting impact on the society, and this is what is happening. What we have also seen in this economy is that your FD rate has become a savings rate essentially. So this means that we are in a very treacherous territory globally. There is a shift which is happening from bonds to equity. Within equity, there is a shift which is happening from developed market to emerging market. So these are the two trends globally. Now, just to correlate this to what does it all mean for certain segments of the market, what you find here is a chart which articulates that what is the correlation coefficient of mid cap index to interest rates. And what we have seen in the economy till now post COVID is that the AAA rated corporates can borrow at this particular point in time. So what you see clearly here, from 2013 to 16, interest rates declined. This led to a very sharp rise in small and mid caps, because essentially there are two things which are happening here. One is that the environment is very constructive, and they are very sensitive to interest rate movement. So essentially the correlation coefficient is 0.7, which is very a strong correlation coefficient. So we just wanted to highlight what could happen. Now, in terms of the outlook, and this is what we clearly believe in, what has happened in India is that, we are living in a deflationary environment globally. So land our historical textbook factors of production continue to be in a very very benign environment at this particular point in time. So essentially we would also be part of the globally deflationary environment. I don't think so going forward anybody anticipates land as a percentage of project cost for an entrepreneur to go up to 60%. Let's say if it was 60% at peak, possibly it is more like 40% today. uh, Wages to go up, we would be in a benign wage environment, essentially because of uh, unemployment being very, very high across various economies. Capital, I think so, we have clearly spoken about. I think so. This is a lowest cost of capital environment that we have seen in India, and technology deflation, which is essentially created by geo in this country. So our view is that all these factors of production are uh, are in a benign environment. Now, what does it mean for an entrepreneur? Obviously, an entrepreneur cares about your cost of capital versus return on capital spread, and this is what has precisely happened in US. So let's say earlier your cost of capital was 10% and your return on capital was 15%. So there was a 5% spread. Today, possibly your cost of capital is more like 7-8% and your spread is like 12-13%. What it also means for an equity investor in a low interest rate scenario is that essentially it is going to be a function of 15% market return is going to move to more like 10-12% going forward. So this is what our belief is. Has been a very very interesting market, because if you just step back and analyze what happened and how sectors have moved. Initially we all saw pharma doing very very well when COVID started, because obviously there was a severe shortage and there was a stockpile which was required. So hence pharma did very very well. There was a lot of disbelief that essentially IT cannot participate in this rally, because initially there was a disbelief that IT budgets are going to take a knock and this is going to be a solvency driven crisis. But then IT participated. Then there was a disbelief in auto as a sector. The narrative there is personal mobility essentially, and that is why auto has done very well. Then that disbelief spread to spilled over to financials. And what we saw is that financials obviously did well, because as I was pointing out that there are two things: capital buffer, possibly economy doing far better. Initially there was also a worry that a lot of people are going to lose jobs. The commentary that we get from financial institutions today is that possibly job cuts have been sort of reinstated. So this is a very, and now there is a disbelief that consumption cannot do well. So in our view, this market is going to be a very very fast rotating market, and the kind of corrections that we are also seeing in terms of some opportunities, in the sense that a lot of people did believe that Reliance can correct it, corrected. A lot of people believe that Bharti cannot correct it, corrected very very swiftly. So this, all of this creates opportunities in the market. And what we have seen is that for mid and small cap, both interest rate cycle as well as valuations are very very supportive at this particular point in time. How we are trying to navigate is obviously focusing on great companies and good companies wherein we can buy them at fair value. So in terms of our investment process, how we think is that there are three pillars to our investment process. The first thing, obviously for an investor, is to have a framework towards how to buy and what to buy. Buying is a very very important part of investment decision making, and there is a lot of investing literature that typically focuses on buying. The second very important pillar of our investment decision making process is sizing and what we call as allocation. So how much do you buy when you buy? Sizing has a meaningful bearing on the outcome of a portfolio in terms of both risk to reward, as well as how you can generate wealth from equities as opposed to generating income from equities. And if you look at all the investors locally and globally, all the famed investors, they specialize in sizing. By that, I essentially mean that, as an entrepreneur, you take all the risk and you have got all the reward. Let's say somebody like Warren Buffett, Berkshire Hathaway today would be sitting on 40% of Berkshire Hathaway's portfolio would be only one stock, which is Apple. But when they bought into Apple, essentially they would have bought a very, very large weight on Apple, which is more like a 10% weight in the portfolio. So by that, I essentially mean that, you have to focus on the fat pitch, as they call it. And when your risk to reward is very, very favorable, obviously you size more. So we don't believe in running equity-weighted portfolios. We believe in taking an objective view on sizing decisions. The third very important element, and which is least spoken about, is selling. And what we believe is that, obviously you need to run to the door if your investment thesis breaks. The second thing is that, incrementally risk to reward is very, very important when you think about selling decisions. As a manager in 2018, the call that I took is that, essentially that the risk to reward is very, very unfavorable. And what we call unfavorable is more like 1:1. By that, I essentially mean that the small cap index can go up by 30%. It can also go down by 30%. So if anybody, takes that view, because there are a lot of things as a part of our investment thesis that we cannot forecast. So if I have to simply explain it in today's context, equity as an asset class, if I have to tell it to somebody that, it has got a 1:1 risk to reward, which is like Nifty is 14,000 today, it can go to something like, 20,000, but it can also go down to 8,000, so the risk to reward is 1:1. One needs to step back and think that whether it makes sense to allocate capital in a 1:1 risk to reward, simply because, there are too many things as a part of investment thesis, too many unknowns that, people cannot forecast. So what we have said is that, as a part of our philosophy, we need to understand the cycle. We would focus on downside more than upside. If we can assert the downside, obviously upside will come through. Growth is very, very critical, and that is the way we look at, things. We believe that, growth is very critical. As a part of our framework, and what we have been practicing is that, first of all, we created a framework, and as a part of that framework, we said that we want to differentiate how to buy when we buy, so that the buying decision is very well thought through. So this is the checklist based approach that we have, that we follow internally. In this, as a part of this approach, what we focus on is two broad categories, wherein we have got a quantitative criteria in terms of investing into businesses, and we have got a qualitative criteria in terms of differentiating between great, good, and bad. The first parameter is return on invested capital versus WACC. In a great business over 3, 5, 10, 20 years, it always beats weighted average cost of capital. In a good business, it meets. There could be 1 year wherein, it doesn't meet. It could be a year wherein Maruti sales decline by 30%. It could be a year wherein Jubilant Foodworks reports a same store growth which is negative, which could be negative to the extent of, -10. What we have also experienced is that, India has a very, very volatile business environment. Irrespective of the category or the company that we might think that it is not going to go through a cycle, every now and then we see that, there could be one of bad year in a company's history. And an excellent example here is a company like Page Industries. Who would have thought that, you could have a scenario wherein innerwear sales could be negative for Page, or, biscuits wouldn't sell in this country, but it all happens in India. On the bad business side, obviously it doesn't beat cost of capital for a prolonged period of time. Capital structure needs to be efficient. What we call efficient is a combination of negative working capital and debt to equity, which is moderate, which is less than 0.5. Average for us is 0.5 to 1. So we are not leverage averse, but we are careful about solvency in the companies that we invest. As a result of this, we don't invest into sectors which have to inherently resort to leverage of more than one time to generate return. And these are all the usual suspects in the sense that, ports, infrastructure, real estate, long gestation, capital, businesses, power plants. We tend to exclude them out of our analysis. As a result of this, and as a logical consequence, we focus on five sectors. The first sector that we focus on is consumers as a part of our strategy. The second sector that we focus on is healthcare, wherein we believe that India is globally competitive. The third sector that we have chosen to invest as a boutique uh, is technology. The fourth sector is auto ancillary, and the fifth sector is banking. Now, the beauty about choosing these five sectors has been for us that these three sectors, what we believe are lower beta, so they are not as volatile. More importantly, these three sectors, which is healthcare, consumer, and technology, are secular sectors. So we believe that there is a long runway to growth in these sectors. For auto and for banking or for financials, we need to be careful. So we are very, very judicious about where we are in the cycle, how much leverage is there. More importantly, the choice of our sectors helps us to focus more. It also helps us to focus in detail. So apart from focusing more, obviously we have to focus more on detail. What do you do we have to reject within that framework of is cash flow adequacy. For a great business, what we call strong coverage is a combination of a, a, a 70% EBITDA to operating cash flow growth, and that is the number that we would look at typically in the set of companies that we invest into. Adequate coverage for a good business, and weak business and weak coverage for bad business. On the cash flow side, we would also look at operating cash flow based multiple, which is operating cash flow divided by enterprise value. We would look at covenants very, very intricately in the set of companies that we invest. For the covenant, by covenants, we essentially mean things like debt service coverage ratio in a company. On the growth side, we would look at a profit pool in a company or in an industry, and where does the company stack up in that profit pool. Typically, what we have experienced is that, let's say there are 10 players in an industry, top three players would have 50% market share, but they would have a disproportionate profit pool share. Now, profit pools are very, very difficult to construct because a lot of companies in the sector might be unlisted. And that is what we focus on more. As a logical conclusion of this, 60% of our companies are market leaders, 25% of our companies are number two in their particular sectors. Now, the key question is that why would you invest into a challenger? We would only invest into a challenger if it is gaining market share and it is gaining profit pool share as well. So this is very, very important to highlight. We believe that at this juncture, wherein there is a very, very important theme in the market, wherein consolidation is happening across the board, we are seeing the big becoming bigger. So we firmly believe that big will continue to become bigger. It is happening in India, it is happening globally. Some of the companies are becoming 100% of profit pool. There are some sectors which are fairly large. For example, airlines today, what you'll find is that Indigo is pretty much 100% of the profit pool. Even smaller companies, let's say something like a IEX, which is virtually a monopoly because it has got 97% of the power gets traded on the exchange. What you'll find is that it is 100% of the profit pool. What we have all, because the nearest competitor is a loss-making company. So if we can find market leaders in small categories which are 100% of the profit pool, we look at those categories very, very favorably, essentially as a part of our construct. Uh, on the qualitative side, we'll focus on competitive advantage. In a great business, typically competitive advantage is identifiable and sustainable, but there are very few businesses which are not getting disrupted. in India and globally at this juncture. So what we have found is that there are very few businesses wherein you can identify the competitive advantage, and that competitive advantage is sustainable. Now, in a good business, competitive advantage could be identifiable, but it could be also fading. Now, the fade rate is not known to people. Uh, Excellent example here is something about something like branch banking, essentially, wherein the fade rate is not known to people. That till how long branches are relevant, uh, as a how what is the relevance of branches as a bank today. For a PVR, it could be OTT threat. So what we find is that in an age of disruption, a lot of businesses are getting disrupted. Pricing is relatively simple. Whether you can beat inflation and have demonstrate pricing power. In a good business, typically it is market pricing, and in a bad business, you are a price taker. You can't do anything about prices. uh, Character is very very important. Essentially, we would look focus on four things in character of management. First of all, you can only understand character if you have tracked the same company for a prolonged period of time. The second bit is that we would focus on contingent liability as a percentage of net worth, management remuneration, pledge shares, uh, so on and so forth. So these are the things which are very very important when we judge a character of management. We somehow believe that character is something which is very very important, especially, and it gets highlighted in a bear market, or if the wind is against you. So our view is that character is uncompromisable as a process. Alignment is very very important. By alignment, we essentially mean companies, when they allocate capital, how do they allocate capital? Whether every incremental rupee invested into the business beats cost of capital. If it doesn't, what is the reason why it doesn't meet? And obviously, dividend payout is very, very important. Dependence on external variables is very important. By that way, I essentially mean how is the regulator in the sector, if the sector is regulated, and where we are in the business cycle. Now, the key question came that, uh, how do we rank companies? And we do it in a very very simple fashion, which is very very uh, understandable. So what we have said is that essentially it is going to be a function of differentiating between good and bad. And it is very very easy to differentiate between good and bad, because good and bad is more like black and white. It becomes very very difficult to differentiate between good and great. When companies become great, we realize that they have become great. So as a logical conclusion, what we have said is that for these are 10 attributes that we have in the framework. For every great attribute, we'll give a score of 3 to a company, and this is getting represented by the 3 ticks that you see on the screen. For good attribute, we'll give a score of 2 to a company. For a bad attribute, we'll give a score of -2. So what it essentially means is that we are being very very objective in our approach in terms of ranking companies. This is a checklist based approach run by the analyst and the fund manager both. Our cutoff score here is 20. And what you see on the screen is a combination of companies wherein we have invested. These companies are all part of the portfolio. And what you'll find here is that, it is a good mix of small caps or platform businesses, which are essentially market leaders. But what you'll find is that, all the companies wherein we believe that these are great companies, the score is going to be more like 24 to 26. We have to yet to stumble upon a company wherein the score is higher than 26. The highest score in our framework is 26. Essentially, uh, now it all boils down to how we navigate markets, and this is a multi-cap strategy that focuses on large, mid, and small. 40% is roughly allocated to large cap. uh, 25% odd is allocated to mid cap, and rest is small cap. We typically don't invest in less than 1000 crore in terms of market capitalization when we invest into companies, because we believe that we have to take care of liquidity. And secondly, if you are investing into a leader or challenger, the category size itself is very very small. What we have been also been in a position to do is to strike a balance between earnings growth, high quality of the portfolio, which is high return on invested capital, and a reasonable PE. So the PE is not, let's say 50% higher than the market PE. We are more like 10 to 15% expensive because we are investing into high quality companies and obviously which are growing much faster. What you'll see here is a good combination of leaders and challengers in the sense that United Spirits, HDFC Limited, Matrimony, Linde, Bharti has now become a challenger. Tharocare obviously is a challenger. So what we believe is that, if we have to invest into a company in a down cycle, obviously it should be the best company to invest into. The proof of the pudding obviously is in eating, and what we have seen is that both in a rising market, in a declining market, and subsequent rise, we were in a position to position ourselves well and navigate. So roughly in last 14 months, we have generated a 2x alpha from the index. And we believe that we have been in a position to navigate it reasonably well. In terms of stock picking opportunities today, where we are, we believe that if the cycle is going to be extended, and if the cycle is going to start, disproportionate benefit is going to happen to a lot many companies. uh, till 3 months back, stock picking was relatively easy. We could have found many companies wherein a 4 year, 5 year return was closer to zero. So that is a value bit of the portfolio. But we believe that these companies have a headwind in terms of cycle. But going forward, possibly these are the companies which are going to bounce back very strongly. And that is how we positioned ourselves in terms of buying great businesses at fair value and buying good businesses at a discount. So I'll just take a pause here. I'm most happy to take questions on markets. Or
Thank you, Aditya. That was a very, very informative session. I would request all the participants, in case somebody wants to ask a question, to please type their questions on the Q&A segment. In the interim, there are a couple of questions in my mind, Aditya. I'd like to ask them if you would allow me. First and the foremost part is that with the kind of money that we have seen in the last month, that was nearly 66,000 crores, and the trend seems to be continuing in the month of December, which is a very, very unlikely kind of a scenario, because normally December we have seen that FIIs take the money out. Having said that, last 2 months is also the point when we have seen an abnormal rise in both Sensex, when you talk about the large cap or the mid cap. Do you see this trend continuing? And because of this trend, in case it breaks, do you see a correction coming across in the Indian markets? Because that is what most of the, I would say, investors are waiting, looking at the fact that the markets seem to be overheated right now.
So essentially, see, Anjush, there are two parts to it. The first part is that, if you look at a 15-year standard deviation on a Nifty index, and which is, the index, what you'll find is that, that standard deviation number is 22%. So you get a 22% move here or there, basically, index. Now, there are some years, fortunately, unfortunately, in the market wherein you can wait for a correction and the correction won't happen, right? Typically, what I've seen is that India is a part of emerging market, which itself is a very, very volatile asset class, basically. And this has been one of the years wherein we have disproportionate inflows. But my worry also is that today what is happening in the market is one has to take a view on debt as an asset class. I think so there is a bigger bubble in debt as an asset class, both globally and locally. If I look at equity as an asset class, it all depends upon the horizon that you have. Obviously markets will correct at some particular point in time. All of us do believe, all of us started to believe that Reliance as a stock won't correct, but a correction in Reliance happened. Bharti, as I clearly pointed out, there is a correction that happened. But we are at a juncture, if I look at today, our portfolio construct as well, if you can invest into a United Spirits wherein, the 5-year return is zero, or let's say something like ITC, which has not performed or participated. The only problem here is that, you wouldn't find 100 stocks wherein you can go and invest, but you will still find, 25, 30 stocks which can give you reasonable return. So the answer lies in what is the horizon that the investors have. If you have a 2-3 year horizon, I think so we are at the start of the cycle. And what a correction means to different people, in the sense that, we might see a scenario of 10% correction. So and the right way to think about it is that, if I believe that I am in a earnings recovery camp, which we clearly believe that, we are in a mean reversion earnings recovery camp. Let us also not forget that, once earnings come through and once the economy starts to do well, it can continue to do well for 2-3 years, right? So let's say even if market multiples are elevated today, and we all know that we are living in an elevated multiple world, let's say earnings growth averages at 10 to 12% going forward, right, for 3 years. Now, what it essentially means is that, your PE multiple is same, but your market returns are going to be trending in line with earnings growth. Returns are going to be in line with earnings growth, which is like 10-12%. So objectively, you have a 30%, 30-40% upside in the market, right? Now, as opposed to that kind of a upside in the market, what is a downside in the market? And, corrections could be very, very sharp. So if somebody is willing to, have a, view that, on a 10%, 15% correction, I'll allocate more, it makes sense. But that decision needs to be made today. Typical investor behavior is that, when markets correct by 10%, then people will wait for a 15-20% correction, right? So the only point here is that, that you need to be allocated to equity as an asset class. If you have 100 rupees, possibly you can be allocated 70-80 rupees today and wait for the correction. But this is not a scenario wherein, you are allocated 50% and you are waiting for a correction. Then, the problem is going to be inverse, in the sense that, if markets continue to move higher, then how do you allocate? It becomes a bigger problem. So it is not challenging, I think so. If one has to take a 2-3 year view, possibly, it is a okay sort of market. The more I see, but your expectations need to be, much more reasonable from equities as an asset class. It cannot be like a, northwards of 15% return. If it happens, it happens, basically. So that is what I would like to point out.
So we have a question from Mr. Prasad. It says, this year has been the most abnormal year of our lifetimes, when few predicted doomsday. However, the market has been on a record high. Post-lockdown, which has also been so abnormal. Hence, what is the market cycle we would see in the short term of 1 to 2 years? Will there be major corrections or move in a normal pendulum?
So, to be very honest, nobody knows. I cannot make a claim to know, but I'll just try to address that. Essentially, corrections will happen. Corrections are bound to happen. Mean reversion is a law of nature, basically, and they happen, when we don't expect them to happen. Our view is that, short-term corrections will give, if you have a moderate return expectation, and this is a link question again, to what I was saying earlier. If your return expectations are moderate or modest, basically not what, equities have delivered in the past, in the sense that, if anybody would have to ask me that, possibly in 14 months, could we have generated, 30% return? In October, this return was more like 15% in a flat market. So I would have said that, possibly it looks difficult to generate, that kind of alpha. But the fact is that, things happen. So in this entire environment, what I've also seen is it is a choice of the product. It is a choice of strategy that you have. And let me take an example here. Uh, Till October, market was more or less flat from the day we launched. So it had been, more or less like 12 months. So what we say is that, as long as we are in a position to navigate well and generate 500, 700 basis point alpha net of fees and expenses for clients, what it also means is that if let's say market is negative, and market is negative to the tune of 5-7%, the portfolio is positive. I think so that is a reasonable outcome to have in the portfolio. So I would say that, it is about doing a balancing act, and have a balanced view in terms of, and being objective about things. So that is the only point here, in terms of, how, what we can expect going forward. The clear cut answer is, nobody knows that, over the short term, what is going to happen. But one thing which is very, very clear at this juncture is that there are a lot of companies which have utilized this opportunity of strengthening the competitive advantage, if I may call that, and what we are experiencing in our portfolio. And I can just talk about, a little bit of bottom up work that we do. 90% of our companies wherein we have invested today are gaining market share in a down cycle. And I'll give you an example. Let's say HDFC Limited, which is the flag bearer of mortgage lending in this country. Now, what we see suddenly is that, in the previous cycle, people used to say that, Piramal or India Bulls is the next HDFC. And you have a challenger, formidable challenger, basically, to HDFC. The fact is today is that, there seems to be no challenger to pure play mortgage lending of HDFC in this country. The similar thing is true of a Maruti. Maruti will emerge out to be a stronger company post-pandemic, in our view. The same is true of Indigo. The same is true of Ashok Leyland. So our view is that, all the leaders, because what do leaders do in a down cycle? What do great management teams do? They execute well, and after a long period of time, after possibly 3 years of demonetization and GST, we have seen a real shift in unorganized to organized. So there is too much of noise. But what I would say is that, competitive positioning is very, very important. And this is the read through when we look at companies and when we analyze companies. What we are saying is that, how is the competitive positioning in the sector, even if there is no tailwind in the sector today? When that tailwind comes, obviously that company is going to benefit.
That brings me to another question. That with the way we had seen gold moving up abruptly in the first half of this year, and then we have seen a correction, and with the kind of dollar inflows that are happening all across, the massive liquidity thanks to all the central bankers, do you still feel that there can be an upside towards gold? I know it's completely outside your domain, but being somebody who understands about these things a little better than people like us do, what would be your view as far as gold is concerned? And would you still recommend people to look across gold as an asset class?
So gold certainly, deserves a place in the portfolio for Indian investors, simply because, 4% return has been made in rupee devaluation versus the dollar over a long period of time. And gold has been a hedge against inflation. I think so. The CAGR number is more like 9%. With gold bonds, obviously, it is a good instrument. The problem with gold is that, like any other asset class, what typically tends to happen with gold is that, it has its own period of outperformance and underperformance. Uh, the problem in a gold view, year till date has been that it has done very, very well as an asset class year till date. So what we have seen is that, when an asset class does very, very well, and if you miss that period of return in that asset class, obviously your return expectations need to be moderated going forward. That is very logical to expect. And this is the same thing, about equity and as an asset class. If you join the party late, obviously, you cannot expect to have a similar sort of return expectation, what happened. So what my view is that, it has got an excellent correlation to M2 money supply growth globally. If you believe that, the central bank printing press is on, please go and buy gold. The problem in gold allocation is that, it cannot be 30, 40, 50% of your portfolio allocation. Another thing about gold is that, all of us, knowingly or unknowingly, because we don't value gold as Indian households, we have some exposure to gold, basically, because typically as a percentage of your portfolio allocation on net worth, you don't tend to, that is not typical behavior that, you start to value jewelry which is sitting in house. Possibly you will value, something like paper gold, or, gold wherein, you have got a biscuit or something like that. So my view is that, it deserves a part in the portfolio, but you cannot be, overly invested into gold. And we have all seen the kind of mania which is happening in Bitcoin at this particular point in time, because it is a new asset class loved by millennials. So our view is that, gold deserves a place in the portfolio, but I don't think so you can allocate more than 5 to 10% in gold as an asset class.
Thank you. I think we don't have any further question. I'll add one last question from my side. As this is a close-ended structure, and if people invest now, what would be your investment strategy in this particular AIF for investing, as well as trying to exit over the next 3.5 years of the fund?
Yeah, so we have taken adequate care in terms of having a mandate, wherein what we have said essentially is that we will take money in two tranches, that is between today and March. On top of that, we have a leeway of creating a cash call in the portfolio. We can have a 10-15% cash. Half of the portfolio focuses on value as a strategy. Half of the portfolio possibly is making a new high as the market moves. So what I'll say is that, essentially we are focusing on both elements. We are sensitive about deploying capital. We don't want to deploy into overheated markets. But at this particular point in time, I think so we are very, very comfortably positioned both in terms of stock allocation. We can find a lot of companies in the portfolio which have not done well for last 4 or 5 years, and which are expected to do well. So our view is that, we are very, very comfortable moving between small, mid, and large, a combination of defensive sectors. And more importantly, when a sector underperforms over the short term and we see opportunity to allocate more capital to that sector, we'll take that opportunity. Just as a recent example, pharma initially did very well. Then we saw that, a lot of pharma stocks corrected to the tune of, 15 to 30%. Now, if as a multi-cap strategy, we can capitalize on that, and being small in size, obviously, it has its own advantages in being, very, very nimble in terms of our investing process. So I would say that, if a correction happens between today and March, we will deploy slowly, and obviously, we can capitalize on this opportunity.
Are there any questions from any audience for Aditya?
I think so. I can see
Seems to be one. There's one more question. It has come from Mr. Surab Shroff. He says, pharma and IT have already moved up. Which sector do you think will move now?
Yeah, so I think so. Consumer as a sector will do very well, going forward, because, there are, if you look at what has happened in the economy, initial reaction to COVID obviously was that, there was too much of fear of losing a job. I think so as COVID progresses, as people start to live with the virus, as vaccine comes through, people would have lesser fear in terms of, losing a job. The second thing is that, there are very interesting trends that we are seeing in certain categories on the consumer side. We are seeing certain categories, possibly something like liquor as a category, wherein what we are seeing is that, consumers have started to uptrade. Now, why consumers are uptrading is a very, very interesting thing which is happening at this juncture, because, essentially there is so much of a cut in terms of spending in a very, very short period of time that, essentially income's not getting impacted. People want to, go out and spend. And this is what we believe, that there is going to be a sharp rebound if vaccine rollout obviously is smooth. So consumer as a sector would do well. I would say that from a prolonged period, I think so pharma looks like at a very, very interesting juncture, and so does IT. So we believe that as a part of our core strategy, consumer, pharma, IT in totality will do well going forward.